Where we sit today, we see interest in terms of hyperscale, at least, from real estate investors, infra investors, kind of value add opportunistic investors. And then increasingly, you're starting to see other types of structured investment vehicles. And I think a lot of that has to do with the fact that the transactions on offer itself are actually much more broad now than they used to be.
Hello and welcome to Cool Vector. I'm David Snow, your host. And today we're joined by Shivek Ratnasamy. He is a director at RBC Capital Markets in charge of data centers, cloud, and AI infrastructure. Shivek, thanks so much for being with Cool Vector today. Great to have you here.
Thanks, David. Pleasure to be here and talk shop.
Excellent. Well, why don't we just start with the fact that RBC Capital Markets is a very central player in the world of digital infrastructure. You've got a great network. You're involved in many of the most important deals. And so I'd love to use that vantage point to ask you what's going on in the market. Talk about sort of over time leading to the present quite busy moment. What was the range of participants in the market that you could broadly call digital infrastructure? And how has that set of participants expanded as the asset class has become more and more popular?
Great question, David, and very topical. Digital infrastructure as a whole has really come into kind of the public investors' consciousness over the last while. When I started at RBC, it was more of a niche kind of asset class that fit under telecom and has since become extraordinarily broad, and the types of investors have broadened significantly as well. And so I think if you were to rewind the clock back to when we were kind of at that first hyperscale boom, the thesis of data centers as an asset class was broached by private equity. And so people looking for returns in that 20% plus spectrum. And of course, as the asset class developed, private equity money would start looking towards more opportunistic parts of the market. And there was really just a broadening of who was investing in kind of hyperscale type assets. And so where we sit today, we see interest in terms of hyperscale, at least, from real estate investors, infra investors, kind of value add opportunistic investors. And then increasingly, you're starting to see other types of structured investment vehicles. And I think a lot of that has to do with the fact that the transactions on offer itself are actually much more broad now than they used to be. Whereas it all used to be kind of top go M&A, you sell one hyperscale operator from one sponsor to the other. Now you have a stratification of transaction types which seek to match the return requirements of investors with pools of assets more accurately. And so things like yieldco versus devco versus kind of asset level investments into ring-fence assets, those have all changed the nature and type of investors that are in the space.
Well, let's talk about a certain form of financing that RBC Capital Markets is involved with, which is development finance for greenfield data center projects. What is the state of that market now? What are the market terms and what can people expect as far as financing if they're launching into one of these longer term development projects?
If we were to think of the financing kind of spectrum from most speculative at the far left towards most stabilized in the far right, the bank market plays in a good portion of that. On the far left, where it doesn't traditionally play, is kind of greenfield speculative builds with kind of newer operators who still kind of have to tap the non-bank financing market, whether that be hedge fund, whether that be structured type of investors. But increasingly, people are coming to us, very established operators with long track records are coming to us and saying, hey, we have a long-term offtake with a hyperscale type client, so investment grade. Can you help lead or participate in transactions? And so that's the project finance market, which we're very much active in, as are many of our peers, including most notably the Japanese banks, who actually have a cost of capital advantage given their structure, and so seek to play in this space a lot. And so market terms really are for kind of these hyperscale type end clients are DSCRs in that 1.15 range, LTC of 80 to 85%, alongside the typical kind of provisions such as completion guaranteed from the operator side. When you come into that kind of atmosphere with a long track record as an operator and an investment grade offtake, you are seeing spreads over base rates of low to mid 200 range. It works very well for operators who are still pursuing development yields in that 8 to 10% range. And so there is kind of that nice gap between your all-in financing costs and your development yield. So as long as that continues to exist, I think it'll be a booming market. You also have things like devcos, which are fairly new technology that's sprung up in the last couple of years. Again, it's something that RBC plays quite heavily in. But those are essentially where the operator provides a mix of cash flowing, near stabilized or stabilized assets with some development in there. And so essentially the way it works is that you have a very constructive borrowing base from the stabilized assets because everyone loves lending against that. And so the excess proceeds you're able to get from the stabilized part of the portfolio funds your development assets. And I think the nice thing is you can kind of move assets in and out of the devco as they complete, or you want new assets to be developed. And it provides actually a nice way for them to tap the securitization market almost at the end of the spectrum there where things are fully stabilized. So greenfield financing has come a long way. We do a lot of it. You now have hyperscalers, despite some headlines, still taking out records amount of capacity. And they remain very, very popular in terms of the type of credit risk that banks want to take.
Shivek, you touched on this earlier, but can you talk about why it's important to draw a distinction between the sale of assets versus the holdco or the topco?
Yeah, absolutely. What I would point to is comparing Europe, for instance, versus North America. And so Europe, in terms of where they are in the business cycle for digital infrastructure, is kind of a few years behind where we are in the US. And so whereas in the US through 2021 and 2022, you kind of saw that holdco or topco, as you referred to it, M&A boom happen. And certainly we participated in that, taking Switch private being one of those transactions. In Europe, that's kind of what's happening now. So the market is consolidating. You're seeing more topco M&A. Whereas in the US, you're seeing a lot more of a targeted approach to M&A. So you're seeing some minority investment into topco, right? So for instance, Sixth Street went into EdgeConneX or AusSuper went into DataBank. What you don't really see actually at all in the last little while here is entire platform, sizable hyperscale platform M&A. You do see operators trying to walk the tightrope between not giving up too much equity, but rather embarking on what we call capital recycling, whereby they take their stabilized assets, carve it out, ring fence it, monetize around 80% of the economic ownership to a second party, retain minority ownership, but operate the asset, and they pick up a pretty decent fee stream in doing so. But what it really allows them to do is take that 80% of capital that you just monetize and put it into development. So what they're essentially doing is saying, hey, I'm able to develop at 8 to 10% development yields, which is essentially EBITDA or NOI over the CapEx, but I'm able to sell into the stabilized market at cap rates that are significantly lower than that. And so I'm going to capture the difference. Now, with the market we're in right now, with interest rates quite elevated, that obviously has pushed cap rates up a little bit. And in some cases, you can argue that squeezed development yields a little bit as well, because the cost of CapEx is more expensive. Certainly, the increase in development yield over cap rates has narrowed a little bit in the last while. And so that's created all kinds of supply-demand dynamics as well. But essentially, this is a solution to solve the problem of, hey, I don't want to sell my whole company and give up what is growing very, very quickly in this kind of market. And I don't want to raise a lot of equity because equity is quite expensive in this kind of market. So let me figure out how I can finance in the meanwhile and kick the can down the road to when the markets are more constructive for equity stakes.
I'm glad you brought up the interest rate environment. What effect has the elevated interest rates had on deal flow, or at least the completion of these partial monetizations in the market?
It's made capital more expensive and it's increased return requirements, right? And so previously, when we were talking about core investors who tend to be those longer term infra style investors, their return requirements have kind of moved from that mid to high single digit range to that low double digit range. When that happens, obviously, they're going to look at things with a more critical eye, and they're going to make sure that despite some notion of potentially interest rates normalizing over the long term, they're still going to make sure they're underwriting to whatever their core requirement is today. You have to look at the shape of the overall curve, right? That is quite important. And so there was a period of time where people were saying, hey, look, stabilized asset sales still make sense. And they do, obviously, mechanically, they still make a ton of sense. But people were saying, okay, well, let's wait for the interest rates to come down, or we're going to front run interest rates coming down over this process And so we're going to pick up quite a lot of investor interest who are able to see through that. But really, the front end of the curve came down, but the back end, 10-year plus, didn't really as much, depending when you were talking about. And so when you're, again, looking at a hold period of 10 plus years, the front end movement of 25, 50, 75 bips isn't as impactful as the back end staying stubbornly high. Interest rates were low in 2021, and that had a certain impact on the math that people would do, the calculus of hitting their returns. But also what it did is it generally encourages people to take risk, right? That kind of risk appetite has certainly been slowed down by the interest rate environment as we are right now. So certainly has had an impact, but equally, people have done a good job adjusting to it, right? And financing markets have got a lot more sophisticated, and people are better now at matching investors to assets. And so we've been able to offset some of that, but I'd be lying if I said we weren't keenly looking at the curve and watching for signs that there's a sustained move down across the term structure.
Taking into account the many private equity style firms, infrastructure, private capital firms that are in the market, what is the range of ways that these investors can monetize their digital infrastructure investments, with presumably data centers being the most prominent among them?
It's pretty complicated for a number of reasons. Number one is that the amount of capital that these operators have sucked up, for all good reasons, by the way, their growth has been beyond the upside case, I think, of any smart investment fund that underwrote it at the time. It's taken up so much capital that these firms have grown multiple fold, right? We know the take private boom in 2021, and we know what those companies were valued then, and we have a great idea of what they're valued now. And they are, in some cases, valued at multiple times what they were back then, which is not very long ago, which is kind of crazy when you think about it, because they were already fairly mature public firms trading with market capitalizations of 10 billion plus in some cases. They are now very large, and a lot of them are held by sponsors that are competitors with each other. They're probably not falling over themselves to sell to a competitor. And the size of the tickets are now much, much larger. And so with both of those dynamics, you're kind of limiting the potential exit options compared to what would have been, a cleaner slate, say 5+ years ago. So people are increasingly saying, okay, well, what about the public market in terms of IPO? The public interest in investing in the AI that powers infrastructure and cloud has never been higher, right? And it's pretty interesting because there's been a dearth of publicly investable opportunities. We now have CoreWeave, which is great. And we would point to that as actually doing very, very well. There was a lot of back and forth the week it was going to price the IPO. They repriced downwards. But since then, I've been trading very defensively. And I think that's just an indicator that there is this large captive public interest in AI infrastructure. The problem is leverage, really, for these operators to go public, because most of them are taking advantage of securitization programs to fund their development. And these securitization programs are actually great deals for them. They can get leverage in excess of 10x with fixed rates that are pinned right now to spreads of sometimes even below 200 bips. And so obviously, when someone gives you free capital that doesn't seem to cost a lot, they've definitely taken them up on it. And so most of them are running in leverage of excess of 10x, which isn't really palatable for public investors. How do you get down from 10x to whatever amount is kind of palatable for public investors? And we're having real-time conversations with investors now as to what that number is. 4x is probably not going to be reasonable for the operators, and 8x might be a little bit high for the investors in the public markets, but is there some number in between there that might work? Hopefully. The other way to do it, I suppose, is to kind of continuously embark on these capital recycling programs and just end up owning economically not many stabilized assets, but rather plow all your money into development. And you can obviously start dividending out to the existing equity holders, or you can sell, right? Now, again, the selling piece, as alluded to earlier, has a bit of a scale problem. But what we've seen with certain data center operators is that they've started breaking the company up into stabilized co, into development co, into regional co's. That makes it a little bit more portable in terms of selling pieces off. And so Vantage, for instance, has been really smart about that. They've been able to break their company up or silo off, geographic segments DevCo, StableCo, and they don't own a majority, in some cases, of the stabilized portfolio. People really want to figure out kind of what type of company they want to have in terms of data center, how long they really want to hold it, what piece they want to hold, what piece they maybe don't want to hold. All of that is being discussed now and coming into sharper focus. So I'd say stay tuned. We do know there's this insatiable need for capital, and we'll have to find more sources.
What kinds of organizations are the top buyers of stabilized data center assets? Are these REITs? Are they sovereign wealth funds, Canadian pensions? Who has the heft and the capital size to take some of these very large ticket items into ownership?
We're seeing a lot of core infra money come in, and they have longer hold periods. They have return requirements to kind of fit the profile. You also have real estate players, as you alluded to, or more permanent capital like pension funds. The magic here is that to hit your core requirement in terms of returns, you have to assume some kind of future repricing of existing contracts, right? Most stabilized vehicles, by their very nature, have had contracts that were signed in the past, in the not too distant past, most likely, but in the past. So say 2020, 21, 22. Lease pricing has risen considerably since then. How much will it continue to rise? And at what point will it be in 10 years when the contracts in the stabilized portfolio come up for renewal is the real question. Now, with certainty, we can say that they will be higher than today based on what we know. But what is the trajectory of how that increases over the next 10 years is kind of anyone's guess. Certainly, as someone in the space, I would like to think that they will continue to outpace inflation from this point into the next 10 years. The return requirements of core being 10 to 11% rely on those repricings being in excess of the escalators that are applied on a yearly basis, which are, call it 2 to 3%. So that's where the market has encountered a little bit of a bid-ask spread, because you're asking buyers to take a leap of faith or have some imagination into extrapolating out what lease pricing will be, generally not in their hold period, which is 10 years, but for the following buyer's hold period. When you sell in 10 years, the next buyer will pick up that benefit, so they'll be willing to pay you more, right? And so your exit would assume that the next buyer will pay you more, and that's how you make the returns work. We've seen and participated in many of these transactions, and they have been a bit tough to close in general, and we've gotten some done actually, and quite recently. But if you were to look at the ones that actually went to market versus closed, there is, definitely not a one-to-one there. And a lot of that comes down to the buyer not wanting to take the risk when they are a fairly de-risked type of investor that far into the future and predicate a large chunk of returns kind of on that. We've seen actually quite a few people interested in the space, but there is still a little bit of trouble getting those parties over the line.
To your point about the leases being renegotiated down the road, is there a general consensus among investors that that's basically going to happen? Or are there pockets of skepticism that there are risks that would prevent a significant or any increase in leases taking place?
Fantastic question. The answer is quite nuanced. If you were to say, hey, here is where tier one hyperscale is pricing today, will it price higher past inflation in 10 years forward? I think most people in this industry would say yes, but that is a all else equal scenario. So what investors are concerned about is saying, hey, you as an operator are selling me 80% of the stabilized portfolio, and you're continuing to develop other facilities, presumably in the meanwhile. How can I be sure that when a lease comes up from a hyperscaler within the same geographic area, that you will be incented to have them renew the lease here or sign a new lease in the stabilized pool versus your new development? And so the operator and the investor have to have some kind of structured agreement that incents the captive team within the stabilized portfolio to get a lease renewal or re-signing. We have seen deals where there is no economic incentive, i.e. commission, being paid to the operator on lease renewal. And the investor was like, hey, wait a second. I know that costs us money, but that's a mechanism for us to make sure you're actually going to try your best to get this lease renewed. The second piece of it is obsolescence, right? So there's this notion that data centers are space and power and very little else, which I think must be very, very painful for operators to hear because there is actually quite a lot of engineering and thought that goes behind it. Now, while they don't own servers that will quickly become obsolete or GPUs, which are heavily depreciable and obviously have a new generation rollout every 6 months or so, the supporting architecture for these hyperscaler AI type workloads are quite exact and they are evolving quite rapidly, right? A lot of that has to do with the fact that rack densities have gone up by a factor of 5+ in the last few years. The supporting architecture, such as cooling, power redundancy, has to adapt to meet that new architecture. So people are wondering, will basically your building be fit for the type of workloads that will be around in 10 years? A lot of investors are looking and saying, hey, how nimble is your architecture? Will it be adapted? Will it need to be adapted? What kind of workloads will you actually be able to capture? And will you only be able to capture kind of legacy workloads, which means your repricing will not be a positive renewal spread?
Shivek, a question for you about the debt market. The digital infrastructure asset class is generally described as being less mature than other debt markets. Can you talk about the development of the securitization market within digital infrastructure? Where does that stand now, and how does that affect the opportunity for investing and for developing going forward?
It's come a long way. We do it out of RBC, out of what we traditionally call our esoteric desk, which actually gives you some indication as to how new of an asset class it is in terms of data centers, for instance, and actually fiber now as well, right? So that's kind of the latest development in securitization land with digital infras is being able to securitize fiber assets or even warehouse them, which is a trade that we're actually quite heavily involved in, which is to hold future securitization assets on our balance sheet until those assets are ready, and then have them move into securitization vehicle, which is then third-party debt. The securitization market has evolved quite rapidly. When you look back, for instance, at the take privates, there was CyrusOne who did CMBS solution, and most of the other operators followed suit with ABS programs. And ABS, on the face of it, has some attractive features that CMBS doesn't, the ability to contribute assets, pass issuance into the trust. It's a little bit more flexible. You get a little bit more leverage. So I think it wins from that standpoint. And so there's been this absolute boom of ABS issuances from data centers, many of whom are programmatic issuers. The digital bridge portfolio companies, for instance, Vantage, DataBank, Switch, they've been programmatic issuers. It's been extremely helpful for them. And there's just been this broadening of the types of operators as well. Whereas initially it was, you have to own all the assets, right? Because the securitization investors like that. So when I say assets, I mean the underlying real estate. As opposed to leasing it, you own the real estate. It would have to be kind of mostly hyperscale with longer contract lengths. That changed quite a bit. One example where we discovered that in real time is when we did CoLogic's inaugural ABS. They don't always own their underlying real estate because they're very focused on carrier hotel control. So it's a connectivity proposition. And those are often floors and buildings. You have a very long-term lease on the floor. And yet, because the asset class is so appealing in general, their ABS went very, very well indeed. And so since then, you've seen more kind of colo type deals come to the market. You've seen more tranches offered in the ABS. And so it's been very, very constructive.
Is the entire proposition for debt tied to data centers and digital infrastructure that businesses around the world will definitely pay their server bills almost above all other forms of spending because it's so critical to the ongoing operations? Is that the general underwriting thesis?
Yeah, you're basically saying that, hey, the Amazons, the Googles, the Microsofts of the world, they will never default on a lease, right? They never have, frankly. You're underwriting the credit risk of these super investment grade kind of tenants. Now, when it comes to colo, it's a little bit different. You're obviously exposed to a larger number of underlying contracts, which presumably have a range of kind of credit profiles in it. The types of data center operators you're underwriting, even if they're more colo for ABS, still tend to be larger enterprises with critical workloads that are still flowing through the data center. And so if I come back to the case of CoLogic's, being a carrier hotel, the criticality of the workloads that are in these colo type facilities are still very, very high compared to retail colo, for instance. And so the investors draw comfort from that, as well as the fact that you actually have a lot of tenant diversity. As funny as it may sound, when you have a single tenant hyperscale, that, that's a good thing, but that's because they're IG. When you're talking about colo, they might not all be IG. So having a lot of them kind of gives you that comfort as well.
Let's talk about the GPU as a service market. How is GPU as a service changing data centers and the way that people think about meeting demand going forward?
We can certainly chart the impact with the rise of CoreWeave. It's kind of crazy to think that a couple years ago, they were a company valued in the low $1 billion range. And today it's 30 billion plus. The reason that they've been able to grow 700 to 1,000% a year, which is, that number always gets me. It's obviously incredibly impressive. They have taken out a lot of capacity, third-party capacity. It exposes them to what we call the duration mismatch. They're signing obviously long-term contracts with operators, shorter with clients, but equally, there's no way you can grow 700 to 1,000% a year if you painfully constructed all of your own data centers, right? And so what has happened is that there's been an explosion of capacity being taken up by the GPU as a service guys. So obviously not just CoreWeave, but the Lambdas, the Cruzos of the world. And so what you saw was that operators would start mixing GPU as a service tenants in with other kind of more well-known hyperscale tenants in there. They had to grapple with this question of, do I take the higher rental rates offered by the GPU as a service guys versus the lower rental rates offered by hyperscalers, or do I just mitigate their credit risk and do kind of an all hyperscaler portfolio? So, less revenue, but I'm able to finance at lower rates. The answer is different from operator to operator and how they want the top line revenue versus cost of financing mix to all work out.
If you were at a cocktail party or some sort of industry mixer and the head of a very large investment organization came up to you and said, hey, we're thinking about getting into data centers. What do I need to know? What would you tell that person?
I would tell them that what they need to know probably exceeds my immediate knowledge, but that everything I know so far tells me it's not quite as easy as sometimes people think it may be. Ultimately, what's very, very difficult is, I think, two things. Number one is getting the contract, right? You can't really do much until you get the contract. And then number two is executing that contract in a timely fashion without cost or time overruns. And I don't know which is more difficult. What I can tell you is that people fail all the time at one or both. It's not like, hey, as long as we have someone who has successfully won hyperscale contracts, this platform is going to work, right? It's not just on the customer side. You need to have relationships on the supply side. MEP is very tough to get in a timely fashion now, with a lead time sometimes in excess of 2 years, especially in some of the power stuff. We have seen even very experienced operators, for reasons beyond their controls, not be able to meet timelines. And we've had a lot of well-publicized cases of people walking away, not from signed leases, but things like statement of qualifications or LOIs, because timelines are not being met. So I guess if someone came up to me, my first thing would be good luck and let me know how we can be helpful, right?
What makes you excited to be part of the digital infrastructure industry at this moment in its evolution?
I can't help but feel that this asset class is just going to continue to grow. There will be ups, there will be downs. You would be delusional to not think that you're going to have weeks, months, years in the market where there's oversupply, where things look like there's secular change that's happening. But the reality is it's a super exciting field because everything that we know and love, whether it's watching Netflix or having Zoom conversations or talking to family members across the world, all relies on this. I really like this asset class because it presents an opportunity to really understand how the plumbing works and continue to make this a functioning and engaged and connected society.
Excellent. Well, Shivek Ratnasamy of RBC Capital Markets, thank you so much for sharing your insights with Cool Vector today. I hope we can have you back in the future because you're right at the middle of everything that's going on in digital infrastructure, and we'd love your insights.
Thanks very much, David. It's been an absolute pleasure. I always love talking shop.